They didn't think the situation in China could get any worse. The country just said, hold my beer. Everything that has come out over the past couple days has not only missed badly, it did so while accelerating sharply to the downside. Right when the communist officials are gathering for what they call the third plenum, when all the top party members talk about the economy. Well, the economy, and especially the banking system, just gave them very sobering and even alarming statistics to talk about. Chinese loan growth continues to set record lows, though last month's newest record low was a lot lower, pointing to really eye-opening deterioration. Home prices in China are almost in free fall at this point. Some of the worst price changes and comparisons in the entire series, the fifth or sixth worst months in modern Chinese history. Real estate and banking woes have obviously been taking a toll on China's economy and thereby the rest of the world, but the latest results also show acceleration to the downside too. Second quarter GDP just released was a huge miss to expectations. Fixed asset investment, no surprise, slowed yet again. More sharp declines in property development. Chinese retail sales, maybe most important of all, those were actually down in June, and the annual change was barely positive at the lowest rate since December 2022 and the lockdowns. Yet, all anyone outside of China seems to care about is whether the government offers more stimulus. Never mind the fact it obviously doesn't stimulate anything except expectations of Western economists and the media. Like trained seals, every bad number that comes up, they all bark for more of what doesn't work. And keep China's example in mind when you might be tempted to think warmly about the upcoming Federal Reserve rate cuts. China's plight is a cautionary tale on the limitations, the severe limitations of government ability to influence, not control, but to influence the economy and the banking system. And through all of this in China, Xi Jinping has only tightened his grip ever more. Not about the economy. He realizes the margins for doing so are thinning all the time. More so, he's focused on politics, especially internal politics, and most of all, with China's military. In fact, Xi Jinping gathered top military officials last month at Yan'an, which is a very sacred site for the CCP. It was near the end of the Long March and really considered the birthplace of China's revolution, the cradle of so-called New China. But gathering top PLA officials in June of 2024, she said, the gun barrel must always be held in the hands of those who are loyal and reliable to the party. Strictness is clearly required to achieve combat effectiveness. There must be no place in the military for corrupt elements to hide. But when he says corrupt, what does he actually mean? Does he mean strictly just high officials who are taking bribes from the public in order to feather their own nests? Or is he really talking about something deeper, more in line of what we're talking about here? As China's situation becomes more and more dire, corruption isn't about bribes necessarily so much as it is loyalty to Xi Jinping himself. And his vision, his transformative vision as he sees it, for all of China, even the Communist Party, right on down to the very smallest parts of it. So as China continues to move on its managed decline currently in its current system, he's basically tightening his grip to make sure that there is no opposition to his vision of this transformation, when in fact this vision of transformation is most likely just a pipe dream. It's against that backdrop that the third plenum, the very long-delayed third plenum, is finally taking place. According to Chinese Communist Party tradition, the third plenum is supposed to be the year after the Party Congress. So the 20th Party Congress took place in the fall of 2022, which meant that the third plenum should have been held last October and November. Instead, it just never happened. They never really announced much of a delay, they just didn't schedule one. And so many people have been left wondering, when were they going to have this third plenum to talk about the economy? And what does that mean about how China perceives economic risks and what they might do about it? And so they finally scheduled it to begin, well, today, and against all of everything that's happening in the government as well as in the economy and the banking system. Of course, Western officials are saying, okay, here we go. Now the Chinese are going to get serious about stimulus. And I'll give you an example. We think the key is to bring a bazooka stimulus for the property segment so that troubled property assets can be systemically resolved, rather than to go through a piecemeal approach currently seen. That was according to Heron Lim of Moody's Analytics. And that's what they see, the bazooka, 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 bazooka. When, in fact, the bazooka is what got China in trouble in the first place. They used the bazooka to create the real estate problem, not intending to create the real estate problem, but to stimulate the economy as all Western Keynesianism tells them to do. This was in the wake of the 2008-2009 not financial crisis and great not recession. So they created nothing more than an asset bubble in real estate without ever getting the economic recovery that they were seeking. So what exactly was the point of stimulating when all it gave them was a massive real estate bubble to have to clear up at some point in the future? And that point in the future happens to be now. So China's not going to do any more bazookas. Bazookas are done. There's no point in doing it. Why make the bad situation even worse, as they did in 2016, which was the last example of the bazooka? And when it was used, all it did was made the real estate problem that much bigger and did very little, if nothing, for the actual economy. It doesn't stimulate what is supposed to be stimulated. Instead, it leaves them with only bigger messes to clean up. There is no bazooka coming in China. In fact, the Financial Times reported just a couple days ago from what they called one prominent economist with a government think tank. He said we should not expect too much around the third plenum. To understand why all this matters to all of us outside of China, how global the global monetary and economic system is, that's why Eurodollar University offers memberships and subscriptions. And they're now on sale at some of the lowest prices we've offered since our launch. I have a daily deep dive to dive far deeper behind all of these topics that I bring up here on YouTube, including all of these intricacies of the Chinese saga. A daily briefing to keep you up to date on everything that's happening in money and macro. We have memberships with tons of videos on everything from the basics of money and financial concepts, even the basics of QE and QT that you are not going to get anywhere else. We got anniversary sale prices for a limited time only, so check out the details at our website, eurodollar.university. And with that, let's get on to the gruesome details, and they truly are ugly. Starting with what the PBOC reported on Friday from the Financial Statistics Report and to an extent the total social financing, but it was all basically the same thing. China's banks are closing down their loan books and doing so in alarming fashion. According to the PBOC, outstanding RMB loans increased by 8.3% year over year in the month of June, which again sounds terrific. 8.3%, how's that bad? Well, not only was that a record low, that was a record low that was a full percentage point less than last month's record low. In fact, the loan growth, outstanding loan growth, had been 10.1% as late as February, and it had been almost 11% back in October. So a massive and substantial deterioration and decline in the growth rate of outstanding loans just over the most recent couple months, against the backdrop of not just the third plenum, but also all of these rescue plans and stimulus that the Chinese continue to offer. They've been cutting rates, especially reserve requirements. They cut the mortgage rate of the 5-year loan prime rate a couple months ago by a record amount, 25 basis points. None of it is having the effect. As far as the banking system is concerned, there's just way too much risk to continue lending to anything and anybody outside their best customers. Even M2 money supply growth, an outdated concept, but yet a good enough proxy about credit creation and money creation in the traditional banking system, M2 money supply growth tumbled all the way to 6.2%. That's another record low for this statistic, down from 7% year over year in May, and it had been 10% back in November. So from 10% decelerating from one record low to another record low to another record low, all the way to 6.2% in June. Maybe the one bright spot, which wasn't really all of that much of a bright spot, household lending at least turned positive in the month of June, increasing by $571 billion. That was much better than the $76 billion in May and the minus $500 billion in April. But that's still considerably less than what we should get from China in the month of June, from Chinese households. It had been $964 billion last June and $707 billion back in June of 2018, just to give you some context here. So even after very bad months, especially April and May, coming up at 571, that wouldn't even have been a good month if these were normal times, let alone after those two really bad months in household lending. In terms of total social financing, June total social financing was just 3.3 trillion. And total social financing is just China's attempt to get the broadest measure of credit and money creation throughout the Chinese economy. It includes not just traditional bank loans, but bond issuance, some foreign stuff like acceptances, as well as equities and corporate bonds and things like that. So aggregate financing to the real economy in June of 2024 was 3.3 trillion, as I just said. But that compares to 4.2 trillion in June of 23 and 5.2 trillion in June of 22. I mean, it was even less than June of 2020 and only somewhat more than 2019. For the first half overall, aggregate financing to the real economy in China was just 18.2 trillion, well below the 21.5 trillion from last year. Primarily because banks, according to total social financing, like the Financial Statistics Report, bank lending just not happening. RMB loans and aggregate financing to the real economy was just 2.1 trillion in June of 2024 compared to 3.1 trillion in June of 2023. For the first half as a whole, 13.3 trillion in RMB loans. That was well below 15.7 trillion in 2023 and even below 2022. And more importantly, you can see that for the first half overall, RMB loans are now falling further and further behind even the pre-2020 trend. Credit creation had been above trend in the initial aftermath of the pandemic, but it has fallen well behind the trend as Chinese banks continue to become more risk averse and more defensive. Even Chinese loan officers are telling Western media sources that nobody wants to borrow and they don't really want to lend. According to Reuters just last week, real loan demand remains weak, said a loan officer at a major state-owned bank based in Beijing. Currently, we're seeing loan requests primarily from state-owned enterprises and sectors where the government encourages lending, like inclusive finance, including low-income earners and very small companies. However, pushing banks to lend more during economic downturns is merely a stopgap measure, and it's not working. Take inclusive loans, for instance. We're issuing them now, but the risk of substantial bad debt in the coming years is significant. So most of China's economy, they don't want to borrow because they see the economic downturn, and banks really would rather not lend for the same exact reason, but they're forced to lend in certain cases by the government and its priorities, which only threatens other lending because if you feel that there's going to be bad loans coming up down the road, you're not going to be lending in freely in other areas too at the same time. Instead, what it does is it leaves for the Chinese economy, like Western economies, only the safest and least risky borrowers are able to get debt, such as state-owned enterprises. As a result of all this, of course, Chinese home prices continue to fall at an accelerating rate. The NBS just showed that the 70-city home price index was down 4.5% year over year in the month of June. That's the biggest decline yet in this cycle. It's actually the 7th worst annual rate behind only the first half of 2015. In home prices, the 70-city average was down 0.7% for the second month in a row. These minus 0.7% rates are actually the 5th worst monthly rates, twice of them in a row, in the entire series history as well. So China's real estate situation continues to get worse despite all of the quote-unquote stimulus. The Chinese government failing to get a hold of its property sector and its real estate woes, the toll it's taking the economy continues to climb. According to the latest results, GDP in the second quarter was expected to decelerate a little bit to a 1.1% quarter-over-quarter change from 1.5%, this is revised from 1.6%, in the first quarter. So from 1.5% slowing down a little bit to 1.1%. Instead, the government just reported late last night 0.7%. That's a huge miss to expectations and less than half the rate from the first quarter. On an annual basis, GDP increased just 4.7%, substantially below the first quarter's 5.3% year-over-year rate. The rest of the major economic statistics were just as bad, starting with industrial production, which continues to be the best of a bad lot. It rose at a 5.3% year-over-year rate in the month of June, down from 5.6% in May, but that's the lowest since March and really the second lowest since October last year. It's moving back into the 2023 levels, which obviously were no good for China. So if this represents China dumping material and excess production on the rest of the world, what does that say about what that excess must actually represent? Well, we get that sense from China's other statistics, starting with fixed asset investment. Fixed asset investment, 3.9% total. That's an accumulated year-over-year rate, which means the year-to-date first half of the year compared to the first half of 2023, 3.9%, and slowing down again. 0.1% was the private fixed asset investment. Even state-owned fixed asset investment, that's slowing down to 6.8%. But the most alarming of the Chinese statistics on top of GDP, or the reason why GDP was so weak, retail sales in China, consumer spending. According to the National Bureau of Statistics over there, retail sales rose just 2.0% year over year. They had been 3.7%, which was not good last month. That's the lowest annual growth rate since December of 2022, when China was still in the throes of lockdowns. And the monthly numbers, the monthly rate for China's retail sales, actually negative, minus 0.12% month over month in June, obviously much slower than May, which was 0.23%, which wasn't good then. And that followed April, which was barely positive, at least according to these revised numbers. Throughout the first half of this year as a whole, Chinese retail sales increased by just 0.5%. Just 0.5% in the first half of this year. Despite all of the stimulus, despite every effort to get a control over China's economic and financial situation, nothing is being stimulated. So why on earth would people continue to call for more of what doesn't actually work? Because nobody stops and thinks about any of these things. They simply look at China or the US and say, well, the government is doing something. The Federal Reserve or the central bank is doing something, so it must stimulate something. We want more stimulus because we call it stimulus, not because it actually is successful at stimulating. And to give you another example of that, here's Standard Chartered economist Hunter Chan. We expect the Politburo, which is likely to convene in late July, to call for concrete measures to boost domestic demand. What have they been doing all this time? Ramping up fiscal spending by fully utilizing bond issuance proceeds and reducing housing inventory are likely to top the policy agenda. We forecast a 10 basis point policy rate cut in both third quarter and fourth quarter, and a 25 basis point cut in the reserve requirement ratio in the third quarter. Who cares? What is that supposed to do that they haven't done already thus far? We want more stimulus to do what? So we could talk about more stimulus? It doesn't actually stimulate. And as I said, keep this in mind when we think about the Federal Reserve's upcoming rate cuts too. China is a cautionary tale for two primary reasons. The first and most obvious, this ongoing deceleration and even accelerating downside in all of China's channels, whether it be economic or banking and financial. But it's also a cautionary tale about stimulus. The government's presumed ability to influence and even control economic and financial circumstances. What the Chinese show, as really any other place shows, is that their ability to influence the situation is exceptionally limited. It's nothing like what they say in the textbook. Yet everyone continues to look at China as it posts even worse numbers, as if it's going to be a source of stimulus-led recovery for the entire world. That's just not happening, nor should we expect it to happen, because primarily the Chinese government is focused in other directions. Xi Jinping is more concerned about tightening his grip on the military and the party than he is trying to do something about an economy that he knows he has very limited capacity to influence. There are no bazookas coming here. Instead, Xi Jinping's vision is to manage the decline and really just hope that China's transformation suddenly takes flight at some point in the near future before it all goes to hell. And that's really the biggest lesson in all of this, is that China isn't just a risk to Xi Jinping or the Communist Party government there. It's a risk to the entire global system. We've got a massive real estate bubble that continues to not just overhang the Chinese economy and the global economy, but also its financial system that is very much connected to the rest of the world. This is a globally synchronized problem that is plaguing the Chinese because the Chinese have been trying to deal with this problem for all of this time. And now with all of these numbers coming in, accelerating to the downside, We really have to pay attention to what's happening in China and not just for stimulus. China's renewed weakness is coming at maybe the worst possible time as we see signs of the same all around the rest of the global economy, including what the core CPI said about the US situation. And I talked about that in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's anniversary sale. And if you are a member or subscriber, I cannot thank you enough. And until next time, take care.